The instant reaction to the devaluation of the renminbi today was that China had belatedly entered the currency wars. After the renminbi had its biggest daily drop against the dollar in 2 decades, it was easy to see the move as a riposte to the plummeting values of the yen, euro and emerging market currencies, something designed to help restore the competitiveness of China's exports. But the policymakers at the People's Bank of China aren't stupid. Devaluation of 1.9% does little to help the country's manufacturers. Brazil, after all, has seen its currency drop this much in a day at least 10 times already so far this year. The usual scale for a devaluation is at least 15%, and China would need more than that merely to catch up with the drop in the yen or the Korean won since last summer. Devaluation that's too small can often be worse than none at all, because it prompts capital flight in anticipation of more devaluations in the future. Now, that hasn't stopped traders from pricing in a weaker renminbi. On here, the red line shows the value of the domestically traded currency, which is restricted to moving in a band of 2% either side of the daily fix by the PBOC. Now, the freely traded offshore version fell by 2.8%, a much bigger move, while the offshore 12-month forwards, where traders try to guess where the currency will be in a year's time, plunged by almost double the amount of the domestic fix. You can see that in the blue line here. Now, those who think that China's just fired a shot in the currency wars would expect far more in the future. But there are other things going on too. First and most important of those is the slowdown in the Chinese economy, which along with its stock market crash has led to easier monetary policy. In spite of this, the tie to the US dollar has meant that the renminbi has strengthened significantly against several of its biggest, in fact, trading partners. In fact, since last summer, China's real trade-weighted exchange rate, which you can see here, this blue line, has risen 14%, which is more than we've had in the US dollar, which I've got here in red. This is the relative rises since last summer, and I've put on here all the way back to 2007. In fact, the rise in China's currency has been accelerating as it's up at its fastest rate since the aftermath of the global financial crisis back in 2009. Now, given that this strengthening of the renminbis come as China slows and monetary policy is eased, it makes sense that policymakers ought to want to halt the rise without needing necessarily to resort to battles in the foreign exchanges. Now, the second reason is China's desire to have a reserve currency. The IMF is due to decide later this year on whether to give the renminbi its stamp of approval alongside the dollar, euro, yen and sterling. But, and this is crucial, China needs to liberalise trading further in the currency. Today's devaluation comes alongside more freedom in trading, which should help it with the IMF. Now, it remains to be seen just how far the PBOC will adopt what it calls a market orientation. If it does, then one might expect the renminbi to fall a bit to reflect the combination of capital outflows, a weaker economy and looser monetary policy, and perhaps a lot. After all, markets can move a long way. But anyone who thinks that this is China's first step in a series of competitive devaluations without resorting to letting the market decide has to think either that the country's policymakers are very stupid indeed, or that they're trying a very risky manoeuvre in the currency wars, and that could backfire spectacularly.